Today, let's answer the question, how do you invest as a college student or even in your early 20s? I'm not a financial advisor, nor this should be treated as financial advice. I'm just sharing you what I do, and you can decide what you want to do. So I have a very simple principle of investing, and I always stick to long-term investing. So how do you invest as a student? The first thing that you need to take a look and decide is that do you have student debt or do you have any debt at all, maybe credit card debt? For the first scenario, let's say that you do have this kind of debt, specifically student loan or student debt. Do you know how much you will owe once you graduate and how much is the interest rate of that loan? This is really important to think about if you do have this kind of debt before you even think about investing. Because according to mathematical approach, if you do have an interest rate, let's say a typical student loan here in Canada is between 2.5 and 4%. You can look it up. I have a few resources down in the description and Google it. But it's around 2.5 to 4. And you know that a typical stock market return is between 7 to 10%. So mathematically, if you do choose to invest, that loan percentage of the interest that you pay is still lower than the interest rate that you will earn from the stock market. So it does make sense to invest and pay that at the same time. But if for some reasons your loan is higher, for example, if you don't have student loan but you have a credit card debt, for some reason you do, let's say you have 10,000 credit card debt with an average in Canada around 19% interest. This is way higher than what you can earn from even a good year of, let's say, 10% rate of return. This doesn't make sense at all because either way, even if you invest, you're still losing money because of the interest that you pay for your credit card is way higher. This way, it will make way more sense to just pay off the debt first before you even think about investing. You can kind of like calculate all of this thing by finding a bank rate or any calculator, this kind of rate, loans, interest rate online, and just put in your numbers, put in the interest, and then if you do wanna, let's say you wanna invest in stocks, if I do wanna calculate the percentage of return for the stocks, I always put it 8% because it is a little bit more towards conservative, so the number will not be as big, or if the market doesn't do that well that year, it will not differ that much. So the simple rule to follow here is that if you have a debt, see how much you need to pay, see how much the interest is, and if you pay the minimum, how much is that? If you pay an extra $50 or $100 a month, how much will you pay in interest totally? Or like in the end of the day, like if you have a 10,000, I'll put this chart on, you can see if you pay the minimum and then if you pay an extra 50 and if you pay an extra 100, how much you will pay. That differs a lot, as you can see, right? So if you can pay it off this as fast as possible, it will be great. But again, if it's under that 8% threshold, you can allocate a little bit to investing, and this will help you to also build and utilize the power of compound interest, especially when you're still young. We're still 20s, even maybe a little bit before that, you're 19 when you're able to invest, and it will help you a lot on that. Now we talk about how if it's above that 7-8% of the rate of return, it makes no sense to invest, so better just pay it off. But another thing that you do need to pay attention is that do you have an emotional burden, or are you emotionally burdened by this debt? Let's say that you do have a average student loan which is 26,000 and then you feel very uncomfortable with this debt. If you do, it will obviously affect more towards your psychology and personal life. It will be best to just pay it off first, and it's okay to take a little bit of loss in the investing, but at least you relieve yourself from this emotional burden. So if you don't have any debt, or if you do choose the hybrid approach that I explained before, how are you gonna do it? How are you gonna approach this investment? Now, as I mentioned before, I have a pretty simple rule of investing. Take it or leave it, agree or disagree, I will just let you know. You can decide it by yourself. My principle of investing is that keep your investment boring, but make sure that you do understand what's going on and you do understand what you're investing in. Don't just pour your money on something that you have no idea what is it about. Investment is one of the things that you shouldn't bring it up all the time. You shouldn't talk about it all the time. Maybe, sometimes like lately the cryptocurrencies or the GameStop stuff and everyone was talking about it. That's if you do invest in those kind of stuff, it's more towards gambling and taking chances. If it's really a true investment, it's not something that you talk about weekly or even monthly with your friends. It could be even just once a year when you readjust and everything. It's basically something that you don't talk about and you never even touch it. Simple, straightforward, pretty boring too. So what's the investment? Buy a low-cost index fund. That's it. Unless you understand how to pick stock, how to analyze all of this thing like PE ratio, PEG and all of this thing, and you know if there's a stock that undervalued and you want to buy the company, you like the company, and you are willing to spend time in doing all of this research, I would say for 95% of us, it is more beneficially to just buy a low-cost index fund and just put your money there. This is because statistically speaking, as you can see here, most low-cost index fund, in the long term at least, outperform day trader and even individual stock picker. So if you don't want to take the slim chances or do all of this work, even if you understand it, sometimes it's just not worth doing all of that work and taking more risks. It really depends. Maybe you're just better off earning more income on the side. So the best thing that I would recommend you to do if you want to follow this approach is just to open a TFSA, which is a tax-free saving account, or in the US they call it a Roth IRA, which may be something that you heard about it more if you do follow like investment channel, financial channel. Usually they call it a Roth IRA, but in Canada we call it TFSA. Basically, it's an account that you can contribute, and whatever the capital gain and dividends that you earn there is tax-free. Because if you do your research, capital gain taxes is extremely high. So if you're still early in the game, you have this contribution limit, it's not fulfilled yet, you still have gap in here, max it out, and then you can talk about investment outside the TFSA. And you can open TFSA account from like banks or even index fund institution like Vanguard, which is pretty known, or one of like the biggest index fund company that I use, or even like a lot of investing platform like Simple Trade and others. Once you open your TFSA, all you need to do is just determine how much you can and want to contribute to it regularly, every month or every bi-weekly whenever you receive your paycheck, let's say, or your allowance. And this concept is called dollar cost averaging. Dollar cost averaging is basically you contribute an equal amount every month to your portfolio, and what this will do is it will lower your overall volatility rate. Just because, you know, if you pay attention to the stock market, especially right now, everything's going down and it's in the dip. People are talking about, oh, buy the dips, stocks are in the discount. We'll talk about that in a bit. But what you do if you constantly buy in every month is that you do buy high and you do buy low, which means that it will average it out and you won't take as much losses if it does, and you won't gain too much, but that's the price you pay for a more stable investment. Wait, I haven't explained what is an index fund. So index fund, if you haven't known yet, is basically a basket of a lot of like top stocks. There's a lot of different index fund. It really depends on what you buy, and you do need to pay attention. There's like the famous S&P 500, which is top 500 performing company in the US, let's say, or there's also a tech index fund where mostly it's a tech company. There's a REITs index fund, which is a real estate investment trust. It's more towards like real estate index fund. You can research all of this, but there's quite a few known one, and usually people just buy in on that. The reason that this is better than picking individual stocks is that an index fund basically track the market, right? So right now all the markets are going down, so the index fund is going down. But the good thing about index fund is it does track the top 500. Let's say, as an example, for the S&P 500, it only tracks the top 500 companies. So if the company fall under the 500, it gets replaced, which means that your index fund eventually will perform better than if you buy that 500 company individually. Because imagine that some of the stocks of their plummet all the way, and maybe even the company suddenly facing a lawsuit and then bankrupt and all of stuff, it will get replaced before that happen because of the stats, and you won't risk losing everything. Maybe a little bit of something that you do need to know here is that there are a few types. Like an index fund that we mentioned is basically a compilation, the basket of the stocks, right? So if you buy an index fund, essentially you purchase all of these stocks together. If you buy the other one, which usually if you use a Simple Trade and this kind of platform, you buy what's called an ETFs, or an exchange traded fund, where basically you purchase the basket of it. So if an index fund, you buy the whole stocks in this basket. The ETF, you are buying the basket. So this is what you trade on. And the other one is index fund and mutual fund, which we also heard a lot. I do want to explain this right now, and if you don't understand, feel free to post some questions below and I'll answer them for you, because it is important for you to understand it early, because it does make a lot of difference. Index fund is basically almost, it's not really tech, it's not really AI, but it's computers the one who determine what to buy. So it is less emotional compared to mutual funds, because mutual funds, let's say if usually the banks has a lot of mutual funds, they kind of like they have an investment expert who do purchase it. So if you're lucky and your mutual fund is good, they do sometimes even outperform index fund. But mutual fund has a high fee. On average, a mutual fund could charge a fee from anywhere 1 to 4%, which is insane compared to index fund, which 0.1, 0.2, or even sometimes maybe if it's a little bit more complex like an international fund, maybe 0.5, something like that, but it's below 1%, that's for sure usually. And index fund is 2.5%. So even on the paper, if you do make more money with mutual fund, they charge a lot of fees, which if you see this chart, which maybe you, first of all, let's see this. Maybe you think that 2% fee is not that high if you do make a little bit more compared to this. But depending on the fee, if you see the chart, the compound interest that you get and the compound interest that is charged, or the one that you lost because of the fees, is exponentially higher with the mutual funds just because of all of these fees combined. And I hope that makes sense as well. Again, if you have any questions, just post it in the comment. I'm open to answer any question. But one more thing, index fund does usually have a pretty big entrance limit, like maybe 1,000 or 2,000 or 3,000 in the beginning. So you do need to pay attention to that if you have the money and you can afford that. But if you cannot for now, just purchase the ETF first, and then maybe later you can buy the index fund. It's pretty much the same. The only thing is that it really depending on the platform, right? So if there's something wrong with the platform, it could be pretty catastrophical. I think that's how it's pronounced. I couldn't remember, but it will be pretty bad if like the platform, let's say the Wealthsimple, suddenly rug pulled or suddenly dead or server broke down or something. It could potentially, yeah, you know what I mean. Another thing that you may or may not heard of is called target date fund. It is basically an index fund or collections of funds and asset classes that depending on when you plan to retire, it will automatically help you adjust the asset class and therefore adjust the risk that you take. Let's say that for me, let's assume that I'm retiring at 2070. So I will buy a target date fund 2070, which means that they will see, oh, I'm still young, right? 2070 is still a long time, so I can afford to take a lot more risk compared to if I'm retiring in, let's say, 5 years. Because obviously the stock kind of volatile, but it could be crashing in the near future. Right now, everything's going down, right? So if I'm investing aggressively and everything goes down when I'm about to draw it and retire, it will pretty much, yeah, you know what I mean. So by seeing when will you retire, they will calculate if you can take more risk. Like now I can take more risk, and therefore they will put a funds that may be a bit more aggressive. But as you age and as it gets closer to that target date, it will adjust automatically to allow your investment to be more stable, essentially. So I know that you might think, wait, so basically what I'm saying is just buy an index fund and that's it, that's simple. And you might think that it's not fun, it's pretty boring, but I want to see how my stock performing on all of this stuff. And yes, you can do that, and I did, or I do still do that. I am still doing that. And the way that you do this is that only invest what you afford to lose into that more volatile amount. So in my case, I keep it a strict 90-10 rule, which is 90% towards index fund and another 10% in stocks, individual stocks, and crypto. This is because, as I mentioned before, it is more unstable and it is more dangerous if you invest in this kind of thing, if it tanks or anything happens. So I do care to invest a little bit less in the money that I can afford to lose. By the way, if you like this kind of content and would like to learn more, please leave a like and comment down below what you want to know more, and then of course subscribe if you haven't yet. Now, the reason that I'm a big advocate for index fund compared to individual stock is that we know that from the trends, an overall stock market will go up in the long term, but this doesn't happen necessarily for individual stocks. So it is safer if you do purchase just an index fund, because again, it tracks all of these stocks, which means that it will balance and cancel them out, and it will follow the market trend compared to if you buy, let's say, the Facebook stocks before, which now I believe it's still pretty down, still pretty low. And if you do just purchase that individually, whenever that when the price tanked before, or like the Netflix, that when the price drop, it will affect significantly compared to if you buy the Facebook inside the index fund. Obviously you cannot choose because they have decided for you, but it is there because it is a big company, right? Yeah, but if you do buy that instead, you will not experience that much of a drop. One thing that I do want to say right now in this current market situation, but don't quote me on this, this is just what I learned, this is what I think, and this is from every data that I've seen. Obviously, do your own research. But usually, I believe that right now we are in recession just because of the inflation, because of the stock, how the stock performing, and like Warren Buffett say, right now everyone is in the state of fears. According to Warren Buffett, when people are in fears, that are the perfect time to buy stocks because they are at a discount. As I mentioned, all the stocks are dropped right now, so stocks are in discount and we can buy them, and then eventually it will go up. And it usually after recession it tend to go up pretty high, but again, do your own research if you do wanna follow this kind of way. So that's my principle of investment, especially if you're new to this. I know it's pretty overwhelming, so if you need an example, I'll use what I do as an example for you. So the way that I invest is that I have a financial system, which if you want to know how it works, just let me know. But I have a financial system that determines a percentage of, depending on what I earn, depending on the amount, and depending on where I earn, it automatically allocates that percentage into my investment account, which is right now is still well simple. I haven't purchased the index fund yet. I'm still on ETFs, but I will soon though, just because of the things that I mentioned before. For simplicity's sake, whatever I earn, usually 10 to 20% is for investment, and whatever I earn above that, if it's like a bonus, a gigs, or anything, 50% of what I earn goes towards investment, and all of this money that has been percentagely automatically allocated will be transferred automatically to Wealthsimple Trade. And this is the way that I automate my system, so that I don't need to do it every month, which sometimes obviously you forget, you overspend and everything. Once I do that, it is easy. Again, I'm following my principle of dollar cost averaging, which is just transfer everything every month and make it simple and make it more less volatile. Now, one thing that you do need to know is that once that money is in the TFSA, you do need to invest it. I believe if you buy the index fund, maybe not. If you like automatically contribute to the index fund, maybe you can just leave it. But if it's like in Wealthsimple, ETFs, this kind of stuff, when it transferred to the platform, you do have to purchase the ETFs and the stocks. So don't make the mistake of transferring and just leave it there, and then in 10 years you notice that the money just sit there doing nothing and not actually invested. So you do need to pay attention, make sure that it does actually invest it. So again, 90% of them will be allocated to a different index fund that I have, which again, if you would like to know about that, let me know. And 10% of that I will have fun with it to either purchase individual stocks, purchase crypto, and all of these kind of things. But crypto usually, this is personally, I only buy like Bitcoin and ETH, so I always just keep it. I never like sell it or anything. I just keep it, buy and hold. For stocks though, depending on the market situation, depending on what I know, I might buy and sell and change it up. But obviously this is just the little fun stuff to have fun with. So that's how I invest, and that's my investment principle, and that's how I recommend people to invest. Do your own research, obviously. If you would like to learn more, let me know again. And I hope you get value from this, and if you don't understand anything, please do your research and please learn about it. I mentioned this a lot in this video, but it is really important for you to understand what you invest in, so that you don't get trapped into the shiny things, or you don't get trapped to whatever, all this investment scheme and a lot of maybe rug pull and a lot of these kind of things. And sometimes you might be tempted with like short-term results, right? So you want to make sure that you fully understand before you put your money in. And about investing in hype, like I say, just keep it to 10%. But usually when people knows about it, when it hit the press and all of this thing, it might be too late. So usually whenever it's the hype and people like Tesla before, like all of people say invest in Tesla and like the GameStop, once a lot of people know about it, it might be a good time to just take it out. So that's for the videos today, guys. I hope you gain a lot of value from this. Make sure to hit the thumbs up, comment anything down below if you have any questions, comment, concerns, subscribe if you haven't, and I'll see you guys again next Saturday.